In this video we are going to explain exactly what emergency tax is, why it happens, and, most importantly, what you can do about it. Emergency tax is a temporary higher rate of tax that is applied to your pay when HMRC does not yet have enough information to give you the correct tax code. It is not a punishment and it is not permanent, it is simply a precaution, and once HMRC has your details it will be corrected. Emergency tax most commonly happens when you start a new job, and your employer has not yet received your tax details from HMRC. It also happens when you start your very first job and have no previous tax history, when you return to work after a long break, or when your P45 from your previous employer has not been processed in time. In all of these situations, HMRC simply does not have enough information yet to issue the correct code. When you are on emergency tax, your employer will usually use one of three codes. 1257LW1 means you are taxed on a week-by-week basis rather than cumulatively across the year. 1257LM1 means you are taxed month by month. BR means all of your income from that source is taxed at the basic rate of 20% with no personal allowance applied at all. The W1 and M1 codes are the most common, and usually result in a smaller overpayment than BR. Normally your personal allowance of £12,570 is spread evenly across the year. Each month you receive roughly £1,047.50 of tax-free income before any deduction. On an emergency tax code, this cumulative calculation is paused. Your employer cannot account for your previous earnings or tax-free allowance, so they may deduct more tax than is actually due as a precaution. Here is a real example. Someone earning £25,000 a year has a monthly gross pay of £2,083. On their normal tax code of 1257L, they pay £207 a month in tax. On an emergency BR code with no personal allowance applied, they would pay £416.60 a month. That is £209.60 more every single month until the code is corrected. That money is not lost, but it does sit with HMRC until you claim it back. Emergency tax is always temporary. Once HMRC has your correct information, your tax code will be updated automatically, and your employer will start deducting the right amount of tax. Any tax you overpaid during the emergency period will be refunded, either through an adjustment in your next payslip, or directly from HMRC at the end of the tax year. You do not have to sit and wait for emergency tax to resolve itself. You can speed things up significantly. Give your new employer your P45 from your previous job as soon as possible. Log into your personal tax account at gov.uk to check and update your details. If needed, you can call HMRC directly on 0300 200 3300. And if you do not have a P45, ask your employer for a new starter checklist form to complete instead. Understanding emergency tax is useful in several situations. When you start a new job, always check your first payslip carefully for an emergency code. If your tax deduction ever looks unusually high, it is worth checking whether an emergency code is being applied. And if you are returning to work after a career break or a period of self-employment, be prepared for the possibility of an emergency code initially. The most common mistake people make with emergency tax is assuming it will sort itself out and doing nothing. While it often does resolve on its own, taking action speeds up the process significantly. The sooner HMRC has your correct details, the sooner your code is corrected, and the sooner any overpaid tax comes back to you. Do not leave money sitting with HMRC that belongs in your pocket. To recap, emergency tax is temporary and happens when HMRC does not yet have your full details. It can mean paying more tax than necessary in the short term, but any overpayment will be returned to you. Act quickly, give your employer your P45 or update your details at gov.uk, and your code will be corrected as soon as possible. Thank you for watching. If this helped, please subscribe for more everyday money topics explained simply.